Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Data delayed. The all-important US jobs print gets hit by the federal government shutdown. President Trump vows thousands of job cuts, ramping up pressure on Democrats to end the impasse. And the battle to create a Spanish banking giant. The BBVA chairman and Sabadell CEO clash in exclusive Bloomberg interviews as they seek to sway investors during the final days of their takeover battle. Plus, takeoff postponed. Bloomberg learns Boeing's 777X won't start commercial flights until 2027 in yet another delay for the flagship jet. Well, happy Friday, everybody. It was meant to be Jobs Day, but of course the US government shutdown means that is not the case. We are not getting the official jobs data today. And the federal government shutdown, the threat from President Trump to slash thousands of federal jobs, did weigh on the equity rally yesterday. Now, looking at the futures picture, it does seem like we're going to have a positive end to this week. But flip the board over to the cross-asset picture. And when we look at the 10-year US Treasury yield, we are pretty steady at the moment. 409.61, up a basis point is where we are at the moment. Still looking for two Fed cuts before the end of the year. About 80% chance of both of them, according to traders. 117 is where we are on euro dollar. But then keep an eye on Brent. A touch weaker at the moment, but it looks like we're going to have a seventh straight weekly gain amid all of this uncertainty. And Brent at $64 a barrel as we head into that OPEC Plus meeting over the weekend. But let's get a check on how Asia markets are faring now. We can go over to Winnie Xu in Hong Kong. Winnie, what are you watching?
Yeah, so we're seeing that Asian stocks rising for a fifth day, and it still is that AI optimism driving the rally. And we are seeing that really it's that strong momentum and investors kind of that fear of missing out driving that rally, and it's brushing off the concerns around the U.S. government shutdown and also concerns that a bubble might be forming in this sector. Now, we have Korean stock market closed today, so that optimism around AI today, we can see that in the Taiwanese market with the Taiwanese benchmark up about 1% or so. And also, there are lots of expectations coming in when it comes to Sam Altman potentially making these deals with the Taiwanese companies as well. Now, driving gains today in Asia specifically are the Japanese stocks. Now, take a look at what's going on with the Japanese shares. We see that for the Topix index and the Nikkei both up some 1% or so. So we're seeing really solid gains here. Now, remember, tomorrow it's going to be the ruling party LDP's the leadership election coming up. So there is a bit of a volatility, but for now, all eyes are still focused on what's going on with the AI headlines. So you saw that Hitachi up some 10% after that deal with OpenAI, and also Fujitsu similarly up over 4% on the partnership with NVIDIA. Now, Hong Kong is seeing a little bit of a weakness here today if we take a look at what's going on in the shares of the Hong Kong market. So we flip the board and take a look and see that actually HSI and HSCI both down a little, and it's taking a breather after rising for 3 sessions already. And it's quite normal. We see that during the Golden Week holiday when we don't have that southbound flow. And Alibaba here is the outlier, still gaining on that AI strength, while most of the stocks are down, specifically with the travel stocks down after Citi talked about the weakness in the travel data that we are seeing so far during the holiday.
All right, Winnie, thank you so much. Have a great weekend. Thanks for taking us through those Asia markets. Now let's get back to that US government shutdown. President Donald Trump is weighing slashing thousands of federal jobs as the White House looks to ratchet up pressure on Democrats to end the government shutdown. White House Press Secretary Caroline Leavitt told reporters the, quote, entire team was looking at possible cuts.
It's likely going to be in the thousands. It's a very good question, and that's something that the Office of Management and Budget and the entire team at the White House here, again, is unfortunately having to work on today. These discussions and these conversations, these meetings would not be happening if the Democrats had voted to keep the government open.
Let's get more now with Bloomberg's news desk editor Jill Deese this morning. Jill, is this an empty threat? Would the layoffs be legal?
Well, at this point, Lizzie, I think that's kind of an open question here. And certainly it's fair to say that they'll be legally challenged. There's a lot of questions about whether or not the government can actually spend money during a shutdown by, sort of taking even the time to look at these types of layoffs and then, conduct mass layoffs within the federal government. There's actually a union of federal workers that's looking to challenge this legally if this does actually go ahead. So there are several concerns there. One thing that I will point out is already when it comes to the Trump administration, this isn't necessarily, in connection with, obviously this government shutdown, but several of its efforts earlier this year to lay off federal workers have also been challenged. Some of that has been clawed back a little bit. So I do think that's something that, again, is an open question here. Chuck Schumer, the Democratic senator, has kind of implied that he's thought that some of these layoffs are, a bit of an empty threat. But obviously what you're looking at here, Lizzie, is an attempt by the Trump administration to really put pressure primarily on these Democrats to sort of bring them to the table and try to end the shutdown. Remember, they really only need, I think, a handful, like 8 or so Democrats to actually join Republicans in voting for the stopgap spending bill. So we'll see if this pressure actually results in what the Trump administration is threatening, which is these mass firings.
OK, but turning to tariffs, Jill, it looks like President Trump's state visit to the UK might have yielded some relief when it comes to Scotch whisky.
Yeah, so this is one that, we're taking a look at as well. It seems that this is something that came out of the visit between Trump and Keir Starmer just, a few weeks ago. We're looking potentially at the easing, some of those tariffs on Scotch whiskey. The UK has actually argued that this would benefit the U.S. bourbon industry because it exports used casks to Scotch producers. That's according to people familiar with the matter that have spoken to us. The one thing that I think is important to remember, though, when it comes to this potential move is that at this point, nothing's sort of set in stone. And I think, as we all know, when it comes to these negotiations between the Trump administration and, a lot of these other nations that are ultimately looking for various efforts of relief or, sort of ongoing tariff negotiations, is that these are frequently very moving targets. So we'll see whether or not that actually results in some of that relief. But again, it does look like at least there's, some sort of semblance of progress that was yielded there out of that visit between Keir Starmer and Donald Trump.
Yeah, there had been some disappointment after all the pomp and ceremony that Starmer hadn't got more when it came to steel tariffs and to Scotch whisky, but maybe we'll yet to see it. But just on the EU, it seems that the European Union is fighting back when it comes to steel tariffs. They've raised their own levies to 50%. Is this the sort of escalation that precedes negotiation when you're dealing with President Trump?
I mean, I think that that's a fair argument there. If you're looking potentially at sort of how other nations or, other blocs and such have kind of tried to approach these types of tariffs. I mean, look at China, for example, just kind of raising its own. What we're talking about with this particular EU one, those plans to hike steel tariffs on steel imports of 50%, again, that's sort of according to some draft proposals here. I think that if you're several of these, types of, you're trying to deal with some of these negotiations, you're certainly looking at different avenues you have in terms of negotiating with the Trump administration. Again, I think this kind of points to this idea that, a lot of these trade negotiations have been going on for the better part of this entire year, right? It just because you necessarily have levies, if you can kind of figure out some kind of a strategy to bring, the U.S. back to the negotiating table, I think that, if you're any of these blocs in this situation, you're kind of pursuing that idea. So, we'll see whether, that ultimately ends up working out for the EU. But again, I think just kind of points to the fact that a lot of these trade negotiations are incredibly complicated, and it does seem like there's still more to come.
OK, well, definitely still an idea just yet, the EU thinking about raising those steel tariffs to 50%. But a Bloomberg scoop nonetheless. Bloomberg's news desk editor Jill Deese, we thank you so much for the latest. Now, coming back to the government shutdown, key data, of course, on the health of the US economy as a consequence set to be disrupted today. And that starts with non-farm payrolls. This as outplacement firm Challenger Gray and Christmas say that US employers have dialed back their hiring plans, a focus, of course, on the private data while we have these delays on the official numbers. Let's get more on the market impact now. We can bring in Paul Dobson, Bloomberg's executive editor for Asia markets. Morning, Paul. In the absence of the non-farm payrolls numbers, the private surveys, as I say, are giving us mixed signals. We've not just got Challenger, we've also got Revelio. How's the market interpreting all these signals?
Yeah, hi, good morning, Lizzie. So normally we'd be sitting here probably saying macro markets were quiet as everybody waited for the non-farm payrolls data. Today we're sitting here saying macro markets are quiet because we're not waiting for the non-farm payrolls data because we're not going to get it. So, not so many indicators to go on, but we do have those private numbers. And as you said, and I think interestingly from the challenge numbers, if you have a headline, maybe it would be cancel Christmas, because what they're saying is that the hiring plans, especially for temporary workers for the rest of the year, are low. It was the lowest reading for a September since 2011, and that gives you that idea, that the labour market is under some pressure at the moment. The commentary that accompanied it said it was stagnating, not necessarily getting worse, but stagnating, and there's not much hiring or that many firings going on at the moment either, according to that Challenger data. The Revelio one was a little bit more upbeat, but all the same, kind of the feeling is that there's still this cloud hanging over the labour market, and that's what the Federal Reserve has been responding to. That's why they started cutting interest rates at the last meeting, on why people see more cuts coming ahead. And it's going to take quite a lot to push them off that track, I feel, particularly in this kind of data vacuum situation that we've got. It's possible that there will be a reopening of the government and we'll get inflation figures before that Fed meeting. Even then, it would take something of an upward surprise to give the Fed pause when it's seeing the weakness in the labour market, and that's what it's been responding to. And so when you look at the market, sorry to bring it back to what your question was, we've got lower yields, not as low as they were when the Fed had its last policy meeting, but coming back down towards those levels, and the dollar under a little bit of pressure as well as a result.
Well, that's the impact from the data delay and the impact on the Fed. But what about the president's threat to slash thousands of federal jobs? That seems to have weighed on the equity rally a bit yesterday.
A bit. I mean, so the S&P finished more or less little changed, and you do have, the sort of feeling that if Trump follows through with that and does start to lay off large numbers of people, that may sort of cause a knock-on effect, to dent a little bit in terms of the economy, in terms of the efficiency of government, in terms of consumer spending, all of those kinds of things. Maybe it hurts the transport sector a little bit, given government travel is a lot. And the longer that this shutdown goes on, by the way, the same sort of things might apply. But the equity market, I don't think, is too focused on that really at this moment. What it's focused on is this tech AI story, the enthusiasm for it. Actually, in Asia, even more so. So as Winnie was describing earlier, what we're really seeing is, Sam Altman from Alt AI has been traveling around Asia. It's like he's some sort of magician, waving a wand, and wherever he sort of touches, we see a big jump up higher in the stock market as a result. And so, we saw the NASDAQ, we saw the Philadelphia Semis Index, all pushing higher. And in Asia, again, we've got more follow through from that today in our markets. More cause for optimism around this AI story. More deals coming through. Big $40 billion deal for data centers on the slate as well today. So, that kind of enthusiasm, you could call it hype, you could call it bubbly or effervescence or something like that if you wanted to, but that's really, front and center of everybody's thinking right now.
Hype, magic, potato. Paul Dobson, we thank you so much. Bloomberg's executive editor of Asia markets. We thank you. Well, we've got plenty on the docket for today. Coming up at 8:50 a.m. London time, we have the final print for French services, the PMI. Are we going to stay in contraction territory? And then this evening, lots of Fed speak at 6:30 p.m. London time. It's the Dallas Fed President, Lori Logan. She's already said this week that she sees more work needed to reach the Fed's inflation target. She sees the risks on inflation more prominent than the threat of higher unemployment. And then at 6:40 p.m., 10 minutes later, we're going to hear from the Fed Vice Chair Philip Jefferson. His view perhaps a bit more balanced than Logan's. He said both sides of the Fed's mandate are under pressure, but the risks to the employment side are to the downside and the risks to inflation are to the upside. So we'll get their interpretations of this week's data. But later on today, we'll also be speaking ourselves with the Fed Governor Stephen Miron about this continued government shutdown and really whether it's making assessing the economic data more difficult. So don't miss that conversation at 2:30 p.m. London time right here on Bloomberg TV. Later on today as well, we'll be bringing you a conversation with the CEO of Goldman Sachs. Our very own Tom McKenzie will be speaking to David Solomon about the impact of AI on building financial infrastructure for the future. If you're wondering where he is, that's where he is, and that's coming up at 9:40 a.m. London time. But you can get a roundup of all the stories you need to know to get your day going by looking at today's edition of Daybreak, and Terminal subscribers can find it by going to DAYB Go. Coming up, though, on the programme, 5 hopefuls go head-to-head in the race to become Japan's next Prime Minister and to stabilise the LDP's grip on power. We'll discuss what's at stake next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, we are hearing from the Bank of Japan Governor Ueda speaking now. The yen weaker against the dollar. 147 per dollar is where we trade. This as he is saying that the uncertainty has receded since the US-Japan trade deal was struck. He notes that there would be a severe problem, including for the Bank of Japan, if the US economic data continues to be delayed because of the US government shutdown, as we have been discussing. But he doesn't think the possibility of falling behind the curve is high for the Bank of Japan. So we'll continue to monitor those remarks. But turning to the politics now in Japan, the ruling Liberal Democratic Party will tomorrow be voting on a new leader from 5 hopefuls after Shigeru Ishiba stepped down following dismal election results in July. Now, investors will be watching for any signals on fiscal and monetary policy, and we can get the latest now with Paul Jackson in Tokyo. Paul, good morning. Just talk us through what the contenders in the race to become the party's new leader are offering to the Japanese public.
Well, we've got 5 contenders here, all from last year, but I think we can boil it down to the front runners. And essentially, this is a choice between the ruling party members choosing Japan's first female prime minister, its youngest prime minister since the war, or alternatively, kicking the can down the road and going with a continuity candidate that doesn't change the settings. Now, of those 3, the female candidate is Sanae Takaichi. She's a conservative, but she is very much pro-stimulus, so that would have significance for spending and also for the Bank of Japan. Shinjiro Koizumi makes himself out to be a reformer, like his father. He's toned down the rhetoric like the other candidates this year round. Probably less ambitious, his plans this year. That kind of reflects the minority government situation that the LDP's in. It's a little bit more boxed in on what it can do. There's also Japan's top government spokesman, Yoshimasa Hayashi, sorry, excuse me. He's also making up ground on the other 2 candidates, and he has growing support amongst the MPs, which is a key part of tomorrow's vote, because we've got an initial vote which includes almost 1 million LDP members. And the MPs in Tokyo, and we don't see anyone getting a majority in that first round. So that takes us through to the second round, and only 2 people get through there. So it's a case of whether Hayashi can make it into that final round or not. But at the moment, all the polls kind of point towards it being a showdown between Takaichi and Koizumi.
I feel like I know them all now, Paul. Thank you for that. But what's at stake in this leadership race for markets?
Well, I think the key point really is the kind of scary alternative for the markets is Takaichi. I mean, scary for some. I mean, it's probably going to be good news for stocks, because she would ramp up stimulus. And she said yesterday in a report with Kyodo News that she would want the Bank of Japan to hold rates for the time being. Now, that's very different from the other candidates who are saying Bank of Japan policies up to the central bank, which largely favors further rate hikes. Also, then there's the spending plans. She's an active fiscal policy is her viewpoint, although she's modifying that this year to say it would be responsible active fiscal policy. But I think for markets, the takeaway is that if you had a Takaichi administration, it would mean more spending or looser fiscal policy, whereas with Koizumi or Hayashi, it would be more a continuation of what we've seen under Ishiba.
OK, Paul, thank you so much for rounding that up for us. Paul Jackson out of Tokyo. And just turning back to the monetary side of the equation, as I say, we've been hearing from Governor Ueda as Paul was speaking, and the yen weaker against the dollar, currently still at 147 per dollar level. But Ueda really keeping his options open when it comes to the case of whether to hike for the Bank of Japan. He had already said that the central bank would hike if the economy performed in line with forecasts. Here he is saying that there is uncertainty over the slowdown pace of food inflation, but that uncertainty in general has somewhat receded since Tokyo and Washington struck their trade deal, and noting, as I say, that there could be a severe ripple effect for the Bank of Japan if the delays continue with the US economic data because of the government shutdown. But also, out of Japan, some other news. The country reportedly days away from running out of Asahi Super Dry, Japan's most popular beer. The Financial Times reporting that retailers are bracing for empty shelves as soon as this weekend. The shortage comes after a cyber attack hit Asahi's operations this week, and the company says that the disruption is limited to Japan. Thanks for that. But coming up on the programme, Bloomberg learns that Boeing's 777X jet is now slated to fly commercially for the first time in early 2027 instead of next year. So we'll get you the details of our scoop next. This is Bloomberg. Bloomberg has learned that Boeing's new 777X aircraft is facing a significant delay and is now expected to enter commercial service in 2027 instead of next year. Well, we can bring in Bloomberg's transport reporter Danny Lee for more on this hold-up. Danny, nice to see you in the studio. What's holding up these deliveries? It's already been 6 years, right, in the pipeline, and how is this going to affect not just Boeing itself, but its customers as well?
Yeah, so Boeing is communicating privately that it expects its newest marquee jet, this long-haul 777X, to start flying commercially in 2027. And so it's a blow for customers who have been waiting, as you said, since 2020. I think the problem for Boeing at the moment is it raises the spectre of having to take yet another cash charge, a non-cash accounting charge that could be between $2.5 to $4 billion. So this is something that it could ill afford given the number of setbacks it has faced over the last several years. And it's interesting that Kelly Ottberg, the Boeing CEO, had signalled at a Morgan Stanley conference just last month that there was a mountain of certification issues that it was facing that it needed to clear. And so maybe he was indeed laying the groundwork for more bad news that's on the way for Boeing and for the 777X. And we do have indeed earnings that Boeing will be unveiling at the end of October. So maybe we'll get a formal announcement then. But this is indeed a setback given all the problems that Boeing has gone through. Kelly Ottberg, of course, drafted in to tackle the regulatory, financial, production and operational challenges that Boeing has faced.
All right. Bloomberg's transport reporter Danny Lee, lovely to see you around the desk this morning. Plenty to watch out for there when it comes to Boeing as we look ahead to those earnings as well. But coming up on the programme, BBVA and Sabadell clash in a Spanish banking takeover battle. We're going to bring you exclusive interviews with leaders from both companies, both by our very own Kriti Gupta. So stay tuned for that conversation. She'll be on set with me next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Data delayed. The all-important US jobs print gets hit by the federal government shutdown. President Trump vows thousands of jobs cuts, ramping up pressure on Democrats to end the impasse. Elsewhere, the battle to create a Spanish banking giant. The BBVA chairman and Sabadell CEO clash in exclusive Bloomberg interviews as they seek to sway investors during the final days of their takeover fight. Plus, takeoff postponed. Bloomberg learns that Boeing's 777X won't start commercial flights until 2027, in yet another delay for the flagship jet. Well, a very good morning if you're just joining us. Happy Friday. It should be jobs day today in the US, but instead it's day 3 of the US government shutdown, which means we're not getting the official jobs data quite yet. We saw President Trump's threat to slash thousands of federal workers taking a bit of a wind out of the equity rally yesterday. Futures, though, suggesting, as you can see, that we will end the week on a high. But flip the board over to the cross-asset picture, and you can see in your bond space that we are pretty steady on the US 10-year yield. 409.41 is where we trade. 2 Fed cuts still expected despite the data delay. You've also got the yen here at 147 per dollar, falling after those comments we heard from Governor Ueda of the Bank of Japan earlier on this hour, dampening the rate hike bets. And gold set for a 7th weekly gain amid all of the uncertainty around the shutdown and the Fed. And oil here set for its biggest weekly loss since June ahead of the OPEC Plus meeting. $64 a barrel is where we trade on Brent. But let's get now to those exclusive interviews with leaders from the Spanish banks BBVA and Sabadell as they fight over a takeover. Our opening trade anchor Kriti Gupta carried out the conversations for us, and we'll bring you them shortly. But just first, Kriti, give us the background to all of this.
Lizzie, we are in the final countdown. 7 days from today, we are going to get an idea of whether or not this deal is ultimately going to get through. 17 months in the process. That's the magic number. But these deal terms are really interesting. And I want to really set the stage for what you're going to hear from these CEOs and the chairman, of course, at BBVA. Really, the deal term is an all-cash transaction. This is crucial in terms of really what they're offering the shareholder base of Banco Sabadell. This is not a question for the board. The Banco Sabadell board has already outright declined the offer. It's now in the shareholders' hand. And what they would get is one BBVA share for about 4.8, a little over when it comes to that share price. The 17 billion euros is where the takeover price is listed at the moment. This is the second revised offer, and BBVA has waived its right to do it any further. That means no more offers. This is the final offer. Take it or leave it. What it really comes down to, though, Lizzie, is the shareholder breakdown. I think this is really crucial here because there are 2 pieces to this. The institutional breakdown, which is what you hear from Steve behind me, is really crucial. There are some key players. Let me walk you through them. Zurich Insurance. This is a partner for Banco Sabadell. Under a BBVA takeover, it's unlikely that they would keep that contract. So they have actually increased their stake in Banco Sabadell. They are a key voting party. Amundi Asset Management, a similar story, a key banking partner with Banco Sabadell, a contract that may actually get removed under BBVA, emphasis on May. So again, these are 2 key shareholders where together they own over 6% of the entire company. That is a juicy, juicy piece. BlackRock, of course, a major financial institution, is your largest shareholder in Banco Sabadell. BBVA needs them on board for any sort of further move. This is the really exciting one, though. The mystery Mexican billionaire, David Martinez, who has been a board member and shareholder of Banco Sabadell for years. That being said, he's actually come out and said, I'm going to take the offer, really putting himself in as an anomaly among the Banco Sabadell board members and, frankly, in the narrative around Banco Sabadell. That is a win for BBVA, who can now say that they have David Martinez on their side. There are rumors speculating that maybe he might have some sort of role in the future entity if this deal actually does go through. Algebris Investments is another one that BBVA has moved over to their side. Lots going on in the institutional space, but Lizzie, it comes down to the retail base. I think this is really crucial. This is the messaging that BBVA is trying to get across because Sabadell's retail base is actually in charge. These are people that are not only customers of Banco Sabadell, but actually have taken on shares from Banco Sabadell, passed them down from family, generation to generation. There is a sentimental hold when it comes to Banco Sabadell. And according to the bank, those numbers, that cohort makes over 40% of their entire shareholder base. So if you don't have them on board, this deal does not go through. What they need a 50% acceptance. 30% and above will do. One of the key questions on Wall Street right now is how many people can you get on board? We don't get the actual numbers. We don't get a tick by tick of where we are. But this is the question I put to BBVA Chairman Carlos Torres. If you don't get to that 50% acceptance threshold, what does BBVA do next? He explored the hypothetical. Take a listen to what he had to say.
If we were to waive the condition, we would need to launch a second offer at the same price in cash. So it would be actually what the law says, it would be the highest price BBVA would have paid in the prior 12 months. So that would be the price of this offer, just in cash. So that would be the situation. And yes, the math depends on whatever take-up happens after that. So what's the take-up in the first one and what's the take-up in the second one, given that they are the same price. So you can make your hypothesis, but again, this is very hypothetical terrain.
Well, as you can imagine, investors around the world are exploring all of the hypothetical options, especially your investors and, of course, Sabadell's investors. Is that a conversation you've had in terms of what you just laid out with the CNMV?
Of course, the CNMV has approved the prospectus, so all the options that are laid out in the prospectus, which are the ones I'm commenting, are very, very clear. Regarding conversations with investors, I think there has been some confusion in the messaging that has been coming to investors, particularly the retail ones, regarding the fact that maybe it's better to wait for a second offer. Nothing of that sort. So it makes really no sense to wait for a second offer, which would be highly uncertain because it would entirely depend first on the take-up. So if we're above 50, it doesn't happen. If we're below, it entirely depends on BBVA's will to proceed or not. And of course, we would make the decision based on our shareholders' interests always. But even if it were to come, it has no added attractiveness versus the current offer because it would be at the same price. It would be a few months later. So why wait if this offer is on the table right now and you can seize the opportunity right now? And finally, it has a worse tax treatment because it will be a cash offer.
Well, Carlos, let's talk about some of the reasons not to take the deal. And this is something that's being floated around in terms of some of Sabadell's shareholders, which is that there has been a promise from Sabadell leadership of a special dividend to the tune of 2.5 billion euros, extra money that's come from the TSB sale that the leadership over at Sabadell has promised to the shareholders. Is that a promise you can compete with? If not now, then if the deal goes through?
Well, as shareholders know, dividends themselves represent cash back to shareholders that already owns to the shareholders. So you're only giving yourself or you're giving your shareholders what they already own. And that's why when you pay a dividend, the stock price corrects down to on the amount of the dividend because it's a distribution. So the focus should not be on distributions, particularly of extraordinary nature when you're selling a piece of your business, you're selling an asset, as important as TSB was for Sabadell. That generates cash that you give back, but the giving back itself is not a value-generating move.
That was BBVA Chairman Carlos Torres Villa talking there about really what they would do in that hypothetical scenario, ultimately ruling out that not only are they not going to increase the offer, they're also not going to increase their dividends when it comes to maybe attracting some of that retail share base. Well, we put the same questions to Sabadell's Chief Executive Officer, César González-Bueno. Take a listen to what he had to say.
I think there's a high probability that they will, but of course that it's only for them to say. But their persistence, sometimes beyond what was expected in terms of continuing with this deal, tends to show that it might take them to make the decision even if they are in the low 30s, if that would happen in terms of acceptance. And the 50 is unattainable for a very simple reason. 40% to begin with. This is the major argument. There are others. More than 40% are retail. If you wanted to know the acceptance level up to today, it's below 1%. And those don't do it the last day. They do it in a gradual manner, and they have been doing it into a gradual manner over the course of the days, and they remain still below 1%. The 80% of which we have knowledge, which are at the same time our customers, and at the same time our shareholders with more than 15 years of average tenure of our shares. and those are not going to tender. And then, of course, we all know the composition, and we are sharing it with the market, and the market has come to the conviction that reaching the 50% is impossible. Furthermore, they said that they would never go below 50, and now they have opened lately that possibility, and they acknowledge that reaching the 50 is very difficult just by their own actions. They have lowered the threshold to 30.
They have said that that is a possibility. They haven't actually made that change just yet. At the moment, the threshold is still 50. But to your point, they do have the legal ability to do so. Let's explore the hypothetical scenario that were they to move that threshold lower to 30%, include that second takeover offer. Is there a price in mind of what that second takeover offer would be?
There's a huge discussion. What there is certainty is that there is uncertainty of what that price would be. What the chairman of the CNMV, which has the ultimate word, has said is that it will be equal or superior to the first offer. Therefore, waiting has a tremendous incentive, even for those who wanted to tender, because they would have not only a potentially higher price, but furthermore, they would have what in financial terms we call a put, which is the ability to tender in the course of 3 or 4 months at a fixed price. So if the price goes down, they will all tender if the second option occurred, and if the price of Sabadell shares went up, no one would tender. So that means that they would even end up at the low end of the 30s and then have to move through in order to get a potentially higher shareholding, which adds even more risk, or that they might have to put on the table up to 12 billion in cash.
Sabadell CEO there, César González-Bueno, talking to us exclusively about that 50% threshold. Lizzie, this is neck and neck. 7 days here. They are quite literally fighting for person by person to get it. And that's the point that César was making there. This retail base that is really primarily concentrated in Catalonia, in Valencia, in kind of the northern part of Spain that is so deeply entrenched in the politics of Spain. They're not feeling too hot about a bigger bank taking over relationships and client relationships they've had with Banco Sabadell for years, for generations. And that's the hurdle that BBVA is facing. Then again, anything can happen. Maybe the institutional investors will come to the rescue. We can, of course, watch those full interviews online at Bloomberg.com.
Well, thank you so much for bringing them to us. Kriti Gupta, our opening trade anchor, of course. And Kriti will be back at 7 a.m. London time on the opening trade. But how lucky are we to get both sides of that takeover battle? As she says, you can watch them both on Bloomberg.com. Now, to some other stories making news this morning. According to court documents, funds under the UBS umbrella face more than $500 million of exposure to bankrupt auto parts supplier First Brand Group through various investment strategies, with one ranking as the biggest unsecured creditor. Now, the US auto parts supplier filed for Chapter 11 protection in Texas on Sunday following a failed attempt to refinance $6 billion of loans, and amid creditor concern over the company's use of opaque off-balance sheet financing. And Bloomberg understands that Bridgewater's flagship fund soared 26% through September, putting it on track for its biggest annual gain since 2010. Hedge funds overall have posted strong gains this year, aided by surging US shares and volatility in bond and currency markets, spurred by President Trump's trade wars. To geopolitics now. Ukrainian President Volodymyr Zelenskiy says that his country may receive longer-range weapons from the US to counter Russian airstrikes. The comments came after he met with EU leaders in Copenhagen. Ukraine hopes to strengthen its position in any future ceasefire negotiations by conducting longer-range strikes on Russian military targets. And flight operations have been suspended at Munich airport after several drone sightings affecting at least 3,000 passengers. The airport, which is Germany's second largest, grounded 17 departing flights and diverted 15 arrivals to nearby cities. Several airports across Europe have been affected in recent weeks due to these unidentified drones. And here in the UK, counter-terrorism police have named a British citizen of Syrian descent as the perpetrator of an attack on a synagogue that killed 2 people. 2 men died and 3 others sustained serious injuries during the assault on the temple in Manchester, where worshippers were gathering for Yom Kippur, the holiest day in the Jewish calendar. Police said that the attacker drove a vehicle at people outside the synagogue and then attacked them with a knife before being shot dead by officers. Let's return to one of our top stories now, how the markets are coping with a lack of data coming out of the US due to the shutdown. I'm pleased to say we're joined on set by Yael Selfin, Chief Economist over at KPMG. Willie, good to have you round the desk this morning, Yael. We know that this is crucial timing for the Fed, that they're missing this crucial data. I want to come on to the impact potentially of the job cuts that the President is threatening. But do you see the economic and market impact of this shutdown being greater than previous episodes because of the timing?
Well, I think it's really hard to say. It will depend on how long this is going to be, but ultimately data is very important. And the Fed, as you say, will be losing some of the data points potentially as a result of it. It's already a time when there's quite a lot of sensitivity around the data. So it's a little bit tricky. Yeah.
Yeah, we don't know how long this is going to go on for. We had the Treasury Secretary saying that it could hurt growth, indeed, if it is protracted. But in the absence of the official jobs data, I wonder how much purchase you give to the private surveys. How much do you believe the ADP numbers, the Challenger numbers?
Well, ultimately, when it comes to the data, you do want as many data points as possible. Even with the official data, we've seen there's quite a few revisions. It's very difficult to just look at the initial results, and therefore I think the more you look at other surveys, the better. But this is a crucial point data point that you do want to have.
So at the moment, are you seeing 2 Fed cuts by the end of the year?
Still, I think that is probably the most likely outcome.
But the risk more on the inflation side or the unemployment side?
Well, when it comes to inflation, there's quite a few other things going on when it comes to the labour market, when it comes to the migration policies, and when it comes to tariffs, where I think quite a lot of the inflationary pressures are going to take longer to actually come through just because of the contracting that we've seen and because of quite a lot of the exports that we've seen coming, the imports that were coming in earlier on. So I think actually, when it comes to inflationary impacts, some of it will be only seen next year. And it's a little bit of early days, but that would not necessarily impact interest rate decisions this year.
OK, and then you have to factor in, of course, the threat of these job cuts, if they're legal, thousands of jobs. How much would that change the equation?
It will have a little bit of impact, but when you look at where the tightness of the labour market is, it's probably not where the job cuts are going to be. So I'm not sure whether it's going to make a big difference on monetary policy. OK.
Yeah, I also want to talk about the UK, because we were both at Labour Party conference earlier in the week. I was talking to the Chancellor, and she was incredibly adamant that she's not going to pull on the 3 main levers of tax, as the manifesto had promised. But you've been looking at how much headroom she's likely to have if the OBR, the Office for Budget Responsibility, downgrades its productivity forecast. Without those 3 main levers, is she going to be able to meet her fiscal rules?
It's a very good question. For a start, we don't know what that gap is going to be, because ultimately it's really down to the estimates of the OBR of where productivity growth is going to go and the longer-term trajectory, or at least medium-term trajectory. So I'd say our estimates are relatively conservative. We think the gap could be just around 16 billion, which is not as large as other economies. And then she would probably want to leave another gap of at least 10 billion. So we're talking about 26 billion, 30 billion more or less. This is quite a lot of money to raise. If I were the Chancellor, I'd say let's rejig everything, increase the broadest base tax, like income tax, but then maybe lower others. So you will have, everyone will win and lose, but you will have less distortion. I think that is the key.
I chuckle because I hear this a lot from economists, but then wonder whether it would be politically viable at a time when Labour's so far behind in the polls. Yael, the other thing was the Chancellor was very proud of how much the Bank of England's been able to cut rates while she's been in office. I wonder if you see more cuts from the BOE this year. And would they bring consumers out of their shell? Because we know they've been saving a lot recently.
Well, I think there is room for the BOE to cut one more time this year, just because even though inflation is slightly higher at the moment, we are still expecting inflation to go back to target next year. So I would hope they cut in November. It's difficult to tell at the moment. And I think there's still room for at least 2 more cuts next year. When it comes to consumers, it's a really good point, because even though we are seeing rates going down, we've seen saving rates continue to increase. So it's unclear whether they will see it as a signal to consume more.
Well, let's see whether the budget is inflationary as well. Yael, great to have you with me this early hour. Yael Selfin, Chief Economist over at KPMG. We've got plenty more still on the show, so stay with us. This is Bloomberg.
It's a little bit like Blazing Saddles. They've got a gun pointed at their own head. They're the chief executive officer of the country, right? They're going to need people to run the programs that reflect their priorities. So, you know, the threat to fire people who would help them implement their agenda seems a little empty to me.
The Guggenheim co-chairman Jim Milstein speaking there on the US government shutdown and the president's threats to fire thousands of federal workers. But of course, that shutdown means that today usually would be payrolls day, and it isn't. We've got a delay to the official data, hence the reliance on the private surveys, including the challenger numbers. And as you can see here, employers scaling back their hiring plans, also their firing plans. In other words, we've got a bit of a freeze, a stagnation in the US labour market at the moment. But it's not just the jobs numbers that could be delayed. Flip the board over and you've got other numbers up in the air, including the all-important, flip the board over, CPI number as well. But here what you can see is ultimately comes down to the politics. You've got the Treasury Secretary blaming the Democrats for the hold-up on the shutdown. Typically, though, according to this Washington Post poll, it's the Republicans who get blamed for shutdowns when you look back at history. But as you can see here, some of the other reports that have already been delayed and could yet be delayed because of the shutdown. Coming up later today, we're going to be speaking with the Fed Governor Stephen Myron about the impact of this continued government shutdown and whether it's making assessing the economic data more difficult. So don't miss that conversation at 2:30 p.m. London time with Danny Berger and Matt Miller. But before that, don't miss our exclusive conversation, with the Chief Executive of Goldman Sachs, Tom McKenzie. He's going to be speaking to David Solomon about the impact of AI, on building financial infrastructure for the future. That's at 9:40 a.m. London time on The Pulse. The opening trade's coming up next. Critty and Guy are going to be taking you all the way to the market open. That's next. This is Bloomberg.